In today's episode, I'll talk about two interesting stories. In the first one of the day, I'll talk about why India recently hit Bangladesh with a major trade restriction and what it really means about shifting powers in South Asia. And in the second story of the day, I'll talk about why the US dollar's global dominance is slowly being challenged and what that really means for the future of the world's economy. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 20th of May. See, India and Bangladesh usually do not make global headlines over their trade, right? Their economies are deeply linked and their borders are usually busy with goods moving in both directions, and for the most part, they have kept their differences under control. But that very quiet understanding has recently hit a rough patch. And mind you, it's not just a small one. India has suddenly imposed strict new trade restrictions on imports from Bangladesh. Now, these new rules don't just tweak some small tariffs or paperwork, they effectively target almost 42% of everything that Bangladesh sells to India, and that is a huge deal. In very simple terms, India has made it much harder for Bangladesh to sell some of its most important goods to Indian buyers. And while the overall value of these exports of around $770 billion might seem small compared to the size of either of the economies, this move is actually loaded with political and economic meaning. And to understand why this matters, let's first understand how trade between these two countries usually works. See, every year, India buys roughly $1.7 to $1.9 billion worth of goods from Bangladesh. Now, a huge chunk of this is actually clothing. Bangladesh, in fact, is one of the biggest players in the global garment industry, and it is second only to China. Clothes basically account for more than 80% of Bangladesh's total exports. In 2024 alone, to give you an example, it shipped out around $40 to $47 billion worth of ready-made garments to countries around the entire world. But the funny twist here is that India is not a major buyer in that list. We only account for about 2% of Bangladesh's total clothing exports, which is roughly $700 million worth of clothing exports. So while garments are actually critical for Bangladesh's economy, India is actually a very small customer in this entire bigger picture of theirs. But still, for smaller exporters in Bangladesh, the Indian market, especially nearby states like West Bengal, has been very important and an easy access destination. They have relied on land borders to ship goods quickly and also very cheaply across the border. And that very trade relationship also had a very strange but interesting structure. Bangladesh imports a lot of raw material like yarn, cotton and fabric from countries like India and then turns into finished garments in its factories and exports them across the entire world. So in a way, India and Bangladeshi textile industries have sort of fed into each other's growth for many years. It's not really pure competition, but more of a partnership of sorts. Now, for years, India has allowed Bangladeshi goods to come in with very few restrictions. Bangladesh got trade benefits because of its status as a less developed country. So on one hand, Indian consumers got cheaper clothes and Bangladeshi businesses got access to a nearby market which was easy for them to access. So in some sense, it was a win-win scenario for both our countries. But not everyone was happy with this. Indian textile manufacturers, especially smaller firms, had been complaining for years about this. They feel that Bangladeshi exporters get way too many advantages like government subsidies and duty-free access to Chinese fabric, which allows them to sell their products 10 to 15% cheaper than what Indian companies can manage to do. And from their perspective, this is not a level playing field. And this resentment has been simmering for quite some time. But recently, things have escalated very quickly. And that spark did not come from India. It actually started in Bangladesh in Dhaka. See, in mid-2024, as many of you actually might know, Bangladesh went through a very big political drama. Prime Minister Sheikh Hasina, who had been close to India and had ruled Bangladesh for many years, was forced to resign after a period of unrest and student-led protests in the country. She even left the country altogether and came to India during that chaos. As a result, a new caretaker government was installed under Muhammad Yunus, who was a Nobel Peace Prize winning economist and a long-time rival of Sheikh Hasina. And under his leadership, Bangladesh's foreign policy suddenly began to shift. And one of the clearest signs of this shift came in April 2025 when Bangladesh suddenly banned the import of Indian yarn at several key land ports. Now, this was a very big deal because Indian yarn is a major input for Bangladeshi garment factories. And cutting this off basically meant that Bangladesh would now have to look elsewhere, which is mostly to China. And that is exactly what happened. In just a very few months, Chinese yarn replaced Indian yarn in Bangladesh's textile supply chain. In fact, by early 2025, China had taken over more than 95% of Bangladesh's imported yarn market, while India's share dropped from over 50% to almost nothing. But that said, the trade blocs did not even stop there. Bangladesh also imposed restrictions on Indian rice and other products, essentially throwing up a wall against Indian goods in some sense. They weren't minor bureaucratic hurdles, mind you, they were clear signals. Dhaka was moving away from New Delhi and towards Beijing now. In March 2025, Yunus even visited China and returned with promises of over $2 billion in loans, grants, and investment deals. And the timing of these moves was not random. It looked like a deliberate shift both in trade policy and in geopolitical alignment. Now, for India, these actions did not really go unnoticed, obviously. And by May, New Delhi decided to respond to it. India's response came through trade restrictions of our own. But instead of imposing new tariffs or banning products outright, we chose a more clever route, which is that we changed how goods from Bangladesh could physically enter the Indian market. See, until now, Bangladeshi goods, especially garments, plastic, and processed foods, could easily be moved across land routes like I mentioned earlier. Trucks cross the borders at multiple points every single day. But now that very access has been cut off. Right from mid-May 2025, Bangladeshi exporters can no longer use land routes in order to send key products to India. And instead, they are being forced to use just two seaports, which is in Kolkata and Mumbai. And this basically adds time, cost, and also complexity. Now, the thing is, for large exporters, this still might be manageable. But for small and medium businesses, especially those who had built their entire business around easy access to the Indian market through trucks and land ports, this is a massive, massive blow. Now, of course, economically speaking, this will not really break Bangladesh's garment industry because, like I told you, India only accounts for about 2% of its global sales. Most of Bangladesh's exports go to the US, Europe, and other large markets. But this disruption is still very meaningful, especially for the smaller players who depend on cross-border trade. Now, for India, this direct economic cost is very small. The total imports from Bangladesh are a small, tiny fraction of our overall market. And for Indian manufacturers, this is actually a good news because many of them have been struggling to compete against Bangladeshi imports. So now they get a bit of breathing space because of this entire change. So with Bangladeshi clothing manufacturers facing hurdles, Indian garment makers, especially the small and mid-sized ones, hope to win back some amount of their market share. Now, interestingly, this comes at a time when the Indian garment exporters are already getting a boost from international trade deals. The new free trade agreement between India and the UK gives Indian exporters a 12% tariff advantage over Chinese competitors in the UK. Now, that could double India's share in the UK garment market and add another $1 billion in exports. Similarly, recent US tariff changes have made Indian garments a lot more attractive as compared to Chinese ones, potentially giving India a bigger slice of the US market where it already holds about 28% of the textile export share. So the thing is, while India's move against Bangladesh may seem very sudden and also very small in some sense, it is not really coming out of nowhere. It is a mix of retaliation, strategy, and also long-term planning. And at its very core, it's not just about trade, but actually a signal. We are telling Bangladesh that if you restrict our goods and tilt towards China, we can respond in kind. And in a region where economic ties and political interests are very tightly linked, that message carries a lot of weight. Now, whether this turns into a longer standoff between these two countries or just a temporary flare-up of sorts will remain to be seen. But for now, what is very clear is that India and Bangladesh are no longer on the same page when it comes to trade. And that could really reshape how goods, money, and power flows across South Asia in the many more months to come. On that note, let's move on to the second story of the day. See, when most of us think about currencies, we usually think about things like exchange rates for travel or how much the dollar is trading against the rupee. But there is actually a much bigger story that is playing out behind the scene. Now, this is one that could very slowly reshape the entire global economy. This is the story of de-dollarization, and it is gaining a lot of momentum in ways that are starting to feel a lot more serious than it ever did before. So to understand what this means and why this is important right now, let me start with something very simple. The US dollar is not just America's currency. For decades now, it has been the currency of the entire world. Governments, banks, and businesses across the entire globe use it as their go-to for saving, trading, borrowing, and also settling payments. In fact, the US dollar is used in around 59% of global foreign exchange reserves that are held by central banks. Now, that is almost 3 times more than the euro, which sits in second place. It is also the default currency in 54% of all trade invoices. And even when the deals don't really involve the US at all, let's say a Chinese seller with a Brazilian buyer, they usually still settle the deal in US dollars. That is, ladies and gentlemen, how deeply US dollar is embedded in the global trade system. On top of that, nearly 64% of global debt is issued in dollars, almost 60% of all international payments use dollars, and 88% of currency trades in foreign exchange markets involve the dollar on one side. Basically, the dollar is everywhere, and this dominance did not just happen by accident. It actually goes back to 1944 when countries met at a place called Bretton Woods and they decided to build the global financial system around the US dollar. See, back then the dollar was backed by gold, which basically gave it extra amount of trust. That gold link ended in 1971 though, but the dollar still held its top spot thanks to a few big reasons. The US economy remained the largest in the world. Its financial markets, especially the markets for the US government bonds, were big, deep, and also stable. And also, America's legal and political systems gave people across the world a lot more confidence in how their money would be treated. There is also a softer reasons that economists often underplay, which is security. See, research by economist Barry Eichengreen shows that countries that are protected by the US military tend to hold a lot more of their reserves in US dollars. So in a way, the dollar's power is also backed by America's global presence, not just economically, but also militarily. But that said, in recent years, this dominance has started to look a little bit shaky, and one of the key triggers has come from the US itself. See, on April 2nd this year, President Donald Trump made headlines once again by announcing a 10% tariffs on all imports with threats of even higher tariffs on certain countries. Now, mind you, this was not just any other trade dispute. It actually reminded many economists of a major moment in history, which is the 1971 Nixon shock when President Richard Nixon slapped a 10% import surcharge and he broke the link between the dollar and the gold.
If we look back in recent history, the precedents, I'm not talking about the interwar period, there's one partial precedent here, which is 1971, the Nixon shock. But it's very different from now for a number of reasons. First of all, Nixon took two very decisive actions. He went off gold, and he also imposed a 10% surcharge on dutiable imports to the US.
Now, this time, the markets reacted very differently. See, usually when things get tense and risky in the financial world, investors rush to buy US government bonds, seeing them as a safe place to park their money. But after Donald Trump's new tariffs, US treasuries did not really perform the way they normally do. Investors did not really rush in, and that is a very big deal because these bonds are the very foundation of the dollar status as a safe asset. So if people basically start losing faith in that safety, it chips away the dollar's special position. A top economist at the Peterson Institute also pointed out to how this movement felt like almost like a deja vu from 1971, but even more dangerous this time around. Back then, the global economy was much simpler, but today the world is deeply interconnected and with complex supply chains and also trillions of dollars moving across borders every single day. So when a major economy like the US starts playing policy games of sorts, which is announcing new tariffs, then reversing them and then doing that all over again, it creates a lot of chaos. It makes it harder for traders to make deals, for investors to price risk, and for the entire system to function smoothly. Perry Merling, who is a professor at Boston University, summed it up very bluntly and he said, and I quote, "Trump is replaying the Nixon handbook," unquote. But with one key difference. The world is not the same. Back then, the fight was mostly between the US and Europe, but today it is very global in nature.
Mr. Trump is replaying the Nixon handbook, but times 10. Because he's doing much more tariffs. Of course, the world is much bigger then. This was really just a U.S. versus Europe spat, okay? Even getting Japan to revalue was not such a big... Japan was not a big player yet in 1971. Europe was the main object of this. And the pound sterling and the French franc and the Deutschmark, they were separate currencies at that time. The euro had not just happened. So the world is now much more global.
And the uncertainty that is caused by these unpredictable policy shifts is now starting to act like a hidden tax on the system, which is one that does not raise revenue but still damages confidence. So the question is the world actually moving away from the dollar? That is a very big question. And for now, the answer is very complicated. See, experts agree that the shift is very slow. It's not like everyone will suddenly ditch the dollar tomorrow, but the warning signs are sort of adding up slowly. Harvard professor and former IMF chief economist Ken Rogoff said that this is not just about how much of the world's reserves are in dollars, it is about how much money is actually being settled. In other words, what systems systems are being used to transfer money across borders and how much those systems actually depend on the dollar. He also says that the bigger threat is the unpredictability of US policies. It basically makes people nervous, and nervous investors end up tending to diversify. He also says that the real danger might not be a new currency overtaking the dollar, but it could actually be the breakdown of the entire international system where exchange rate becomes unstable, capital flows get disrupted, and long-term planning becomes harder for everyone. But that said, Josh Lipsky, who's an expert at the Atlantic Council, offers a little bit of a different take here. He says that the problem that we are looking at is the wrong signals here. The fact that the dollar is still dominant in trade and reserves does not mean that it is future-proof. Behind the scenes, a new infrastructure is being built. Alternative payment systems like China's CIPS is growing very, very fast. They don't really need dollars to work. And these are very small today, but they are gaining quick ground. And more importantly, they show a desire to reduce reliance on the US dollar. Lipsky also points to something called mBridge, which is a cross-border payment project involving China, Hong Kong, Thailand, and the UAE, and now also Saudi Arabia. This uses central bank digital currencies to settle payments directly between countries in minutes and not in days. Now, this is not just an efficiency upgrade, mind you, it could reduce the entire need to use the dollar as a bridge between different currencies. Marcus Brannermeier, who is another leading economist, zooms in on the core issue, which is the safe asset status of US treasuries.
A political aspect, but also from a financial aspect. And typically, how you get some hedges is to hold some, safe asset, and the safe asset was typically the US Treasury.
Now, this status gives the US a very unique privilege, which is that it can run huge deficits without worrying too much because everyone still wants to buy its debt. But the thing is, if that safety premium fades, the US could face higher borrowing costs, and that in turn affects how much the government can spend or invest. And again, policy uncertainty is at the heart of all of this erosion. So the question then is, what's actually changing on the ground? See, there are a few shifts that are already going on right now. One is the slow drop in how much of US debt is actually held by foreigners. Back in 2008, foreign investors held about 54% of all US treasuries. Now that number is closer to 33%. Even central banks and sovereign funds, who are usually the biggest buyers, have half their share. They are quietly diversifying basically. There is also a slow but a very clear rise in the use of other currencies. In 2024, for example, central banks increased their euro holdings by over 128 billion euros. Now that made up 40% of the global increase in foreign exchange reserves for the year. It's still small compared to the dollar share, but the direction is very clear. Technology is also playing a very important role in this shift. New financial infrastructure is allowing countries to trade directly with each other without really routing everything to US dollars. It's becoming easy for countries like, say, India and China to settle payments directly in their own respective currencies without really having to convert to dollars in the middle. Geopolitics is yet another factor. Countries that once relied heavily on US protection may now be exploring other security arrangements. And when that protection starts to fade, so does the pressure or the incentive for that matter to hold US dollars. And then there's of course trade as well. See, as Asia is now becoming the new hub of global economic activity, and as regional trading blocs deepen their ties, it's only very natural that local currencies will start playing a bigger role. So the question then becomes, where does all that leave the dollar? See, it's obviously still very dominant, but it is no longer untouchable as it once used to be. The most likely outcome is not a dramatic collapse, but a very slow transition into something that we've not seen. This is also what economists call a multipolar currency world. This is a world where the dollar still matters a lot, but it shares the stage with other currencies across the world and perhaps even some other digital currencies that are backed by central banks. As an economist puts it, we may be entering a period similar to the 1930s where the old global leader, which is Britain, could not keep the system stable anymore and a new leader, America, was not ready to take charge. But today, the US has the ability, but the politics may not align with everything. Meanwhile, Europe or China may have the will, but yet not the full ability. Now, for investors like you and me, this means being very thoughtful about portfolio diversification. It may be wise to have more exposure to non-dollar assets, especially as new systems and currencies start to gain traction. And for policymakers, the message is very, very clear. If the US wants to retain its privilege, it needs to maintain global confidence. And that means stable policies, strong institutions, and a willingness to lead the charge here. Because in the end, the dollar's dominance is not just about history, it is actually about trust. And trust once is lost is very hard to rebuild. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, India has set an ambitious target to capture 5% of global semiconductor chip production by 2030 under its Semicon 2.0 strategy. The government has already committed funding from its $10 billion incentive package, with 5 projects cleared by the Ministry of Electronics and IT having a combined capacity of 75 million chips per day. Second, Apollo Global Management is in advanced discussions to invest $750 million in bonds issued by Mumbai International Airport Limited, which is a part of Adani Airport Holdings Limited. The investment is expected to be routed through Apollo's insurance arm. Third and the final one for the day, Vodafone Idea has moved the Supreme Court after the government rejected its request to waive over $5 billion in penalties and interest. This plea follows a formal rejection by the Department of Telecommunications on April 29th, which stated that the relief sought cannot be considered. Vodafone Idea's CEO, in a letter that was dated April 17th, warned that without financial relief, the company would be unable to continue operations beyond FY 2026. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.